All right, let's unpack this. We all want financial freedom, right?
Mm-hmm. Definitely.
The idea of a future where money isn't a constant source of stress, where opportunities aren't dictated by your bank balance.
Yeah, that's the dream.
Yeah, for many of us, the reality is, well, a knot in the stomach when we even think about our finances.
Oh, absolutely. It's common.
It's that nagging feeling of not quite knowing where your money goes or, why you're always just a little short despite working hard.
Right.
What if there was a clearer path, maybe like a detailed map to navigate these waters?
That would be helpful.
Today, we're diving deep into precisely such a resource, a fascinating blueprint for personal finance and wealth growth that one of you actually shared with us.
Oh, interesting. Okay.
Yeah, and this isn't just another generic guide. It feels like a meticulously crafted framework promising a route to eventually never worrying about running out of money again.
That's a big promise.
It is. So our mission in this deep dive is to cut through any fluff, extract the most actionable, sometimes maybe counterintuitive, and truly illuminating nuggets from this blueprint,
Okay.
and present you with a straightforward, yet, hopefully, profoundly effective path forward. Consider this your shortcut to being genuinely well-informed, equipped with insights that, go beyond the obvious.
Sounds good. Let's get into it.
So, if we're feeling a bit lost in the financial wilderness, where does this blueprint suggest we first plant our flag?
Well, it starts with something foundational.
It points to a step that, honestly, many of us probably dread or have maybe tried and failed at before.
Mm-hmm.
Tracking your money.
Ah, yes. The tracking piece.
But it's not just any tracking, is it? The way it's framed seems a bit different.
Exactly. What's truly fascinating here, and maybe often overlooked, is not just that you track, but how the blueprint advises you to approach it.
Yeah.
Instead of like a daily, painstaking ledger, which can feel like a chore, right, and quickly lead to burnout.
Oh, yeah, I've tried that.
Uh-huh.
Doesn't stick.
Right. So the blueprint suggests a more strategic kind of financial autopsy.
Financial autopsy.
Yeah, it recommends setting aside a dedicated hour, maybe each week, perhaps over a cup of coffee, whatever, to meticulously review your last week's or last month's bank and credit card statements.
So, looking back, not trying to capture every single thing in real time.
Exactly. And the directive is clear. Write down every single dollar earned and spent, even the small stuff.
Wow, even the small things.
Yes. And this isn't about judgment, It's pure observation.
Okay.
The profound insight here is that this isn't busy work. It's about gaining absolute granular clarity. It helps you uncover those money leaks.
Those little things you don't even realize add up.
Precisely. The subtle, often unconscious spending habits that just drain your resources. Many people feel this vague anxiety about their finances, a sense of where did it all go?
Mm-hmm.
This initial act replaces that uncertainty with knowledge. It offers what we might call a financial X-ray.
I like that analogy. An X-ray.
Yeah, by identifying patterns, you stop guessing and start knowing exactly where your money is going and how to use it better, which is really the first step in regaining control and significantly reducing that underlying stress.
This is about empowerment through data. Your own data.
Exactly. Empowering yourself with data.
That reframing from daily chore to a weekly financial autopsy for pattern recognition, that feels like a significant distinction.
It is.
It takes away that immediate pressure, allows for a more reflective analysis.
And yes.
Okay, so once you've shone a light into the shadows of your spending with this meticulous tracking, once you truly understand where your money went,
Right.
the next equally challenging step isn't just seeing the path, but actively paving it, ensuring those dollars align with your, deepest financial goals.
Mm-hmm.
And this is precisely where the blueprint introduces its elegant yet powerful solution.
Exactly. The blueprint moves us from observation to active, proactive management, and it introduces a remarkably simple yet really effective psychological and practical system, the 3 bank account method.
3 accounts, okay.
Yeah. The core idea is to open 3 distinct accounts. One specifically for your day-to-day spending.
Like bills and groceries.
Exactly.
Right.
Then another for your dedicated savings goals, maybe an emergency fund, a down payment.
Right, specific goals.
And a third separate account solely for investing.
Keeping investing totally separate.
Totally separate. This isn't just about compartmentalization. It's about creating immediate, tangible financial guardrails.
Guardrails, okay.
By physically separating your money, you make it significantly harder to accidentally dip into funds, meant for those long-term goals.
So it's a physical barrier, almost like a forced discipline.
Pretty much.
But I can imagine some listeners wondering if this level of separation might add too much complexity to their banking routine, juggling three accounts. Does the blueprint touch on that potential friction?
That's an excellent point. And yes, the blueprint anticipates it. It emphasizes choosing banks that offer seamless online transfers between accounts, or maybe even leveraging a single bank that lets you easily open multiple sub-accounts.
Okay, so tech can help smooth that out.
Definitely. The slight initial friction of setting up these accounts is really a small price to pay for the long-term benefits of clarity and control.
And for couples or joint finances.
Good question. The blueprint suggests applying the same three-account principle, but maybe with shared visibility and agreement on those allocation percentages. The goal isn't complexity, it's clarity and, crucially, automaticity.
Automaticity. Okay.
Yeah. And the blueprint also offers a specific, actionable rule of thumb for allocating your paycheck, which is really helpful for getting started.
A rule of thumb, like a percentage split.
Exactly. Consider dedicating 75% for spending, 15% for investing, and 10% for saving.
75, 15, 10.
Now look, this isn't rigid dogma, right? It's a starting point. A guiding principle you can adjust based on your unique situation. Maybe it's 8-0-10-10 if you have high debt, or maybe 6-0-20-20 if you're aggressively saving for something specific.
So it's adaptable.
Very. The key is to have a plan and stick to it.
Right.
But what's truly transformative here, and often the difference between, success and failure, is the emphasis on automation.
Making it automatic.
Yes. The blueprint strongly advises setting up automatic transfers immediately after your paycheck hits your main account.
So right away.
Right away. The money should move to these three distinct accounts without you having to lift a finger.
Takes the decision-making out of it each time.
Precisely. This isn't just about convenience. It's a powerful pre-commitment strategy, kind of leveraging behavioral economics to prevent future impulse decisions. You overcome that present bias, our natural tendency to prioritize right now over the future.
Yeah, that's a real thing.
It is. This automation essentially puts your financial future on autopilot, making it so you won't accidentally spend the money meant for saving or investing, which is such a common and very human pitfall. You build a system that works for you almost without constant conscious effort.
That automation really does sound like a game changer. It moves us from reactive spending to proactive financial design.
Exactly. Financial design.
It removes the temptation and the friction that often derails even the best intentions. Okay, so we're tracking our money, we've got a smart system in place with those three accounts, and we're directing our cash with purpose.
Right, we're getting organized.
But then our source makes this very clear and, frankly, powerful statement. Just working and saving won't make you rich.
Ooh, yeah, that hits hard, doesn't it?
It does. It immediately challenges the conventional wisdom, just save diligently. So what does this all mean for actually growing our wealth beyond just putting money aside?
This raises one of the most critical questions for anyone seeking long-term financial security. If saving isn't enough on its own, what is?
Yeah.
And the blueprint is unequivocally clear and direct here.
Sure.
Your money needs to earn more money.
Make your money work for you.
Exactly. It moves us beyond merely preserving capital to actively growing it, often at a rate that outpaces inflation.
Inflation. The silent wealth killer.
Totally. The blueprint stresses that simply saving cash, while crucial for an emergency fund, often means losing buying power over time because of inflation.
So your saved dollars buy less later.
Precisely. Your diligently saved dollars in a low-interest account will buy less in the future than they do today. This is why investing, particularly in assets designed to outpace inflation, isn't just about growth, but about preserving and enhancing your future wealth.
Okay, so investing is key. What kind of investing does it suggest?
Well, the blueprint gives specific, tangible examples, noting that some people invest in things like rental properties that give you monthly income.
Like a real estate.
Or stocks that pay dividends every few months. But it doesn't just stop there with generic examples.
Right.
One of the blueprint's core tenets seems to be the lazy portfolio approach.
Lazy portfolio. I like the sound of that.
Right. It advocates for broad market index funds over picking individual stocks.
Index funds. Okay, explain that a bit.
Sure. An index fund is basically a basket of many different stocks or bonds. Think of it as instant diversification.
So you own a tiny piece of lots of companies.
Exactly. It gives you a piece of the entire market or a large section of it without having to become an expert stock picker trying to find individual winners and losers.
Less risky, less time-consuming, presumably.
Generally, yes. The blueprint cites studies suggesting consistent outperformance by these diversified funds over the long run and significantly less time commitment for the average person. It's about owning a slice of the whole economic pie rather than betting on a single cherry.
So it's not just about the initial investment, but what that investment then does for you and the strategy behind it. That lazy portfolio idea sounds particularly appealing for busy people.
It really is. And what's truly fascinating, where the real magic of wealth creation lies, is the power of reinvesting any income your investments generate.
Reinvesting. Okay.
The blueprint explains that when you reinvest this income, whether it's from rental properties, stock dividends, or capital gains, your money compounds and grows over time.
Compound interest. Einstein's eighth wonder, right?
Something like that. It's not just adding interest to interest, it's about the exponential acceleration of your wealth. The later years can generate vastly more growth than the initial ones.
That snowball effect.
Exactly. It's the engine of long-term financial growth, turning small, consistent contributions into potentially significant wealth over decades.
Decades. Okay, so patience is key.
Hugely key. However, and this is a crucial caveat the blueprint rigorously emphasizes, becoming wealthy takes many years of hard work and patience, so you have to stick with it and not give up.
Right. It's a marathon, not a sprint.
Definitely a marathon. The blueprint often discusses the psychological barriers to long-term investing.
Like freaking out when the market drops.
Exactly, like the temptation to panic sell during market downturns. It reinforces that market volatility is normal, it's part of the deal, and that consistent contributions, coupled with patience, are the most reliable path.
So ride out the storms.
Ride out the storms, trust the process. It's about building something significant like a financial fortress, and that just requires time, dedication, and the discipline to stick with it even when it feels challenging.
And risk. How does it view risk?
Well, according to this blueprint, risk management isn't about avoiding all risk, because that often means avoiding growth, but about understanding and diversifying it, primarily through that broad market exposure, like with index funds.
Got it. Diversify and stay patient.
That's a big part of it.
That distinction between saving and investing and the deep dive into the patience and psychological resilience it requires is so important.
Crucial.
There are no get-rich-quick schemes here, just solid, proven strategies rooted in consistent action. So let's quickly recap those 3 foundational actionable stages our blueprint laid out, not just for July of 2025, but as truly timeless principles for anyone listening who wants to transform their financial reality.
Okay, the 3 steps.
First, start by gaining absolute clarity through tracking your money, perhaps with that weekly financial autopsy.
Step 1, know where it's going.
Second, create a robust, automated system to manage it, like the 3-account method, ensuring your money flows where it's intended.
Step 2, build the system, automate it.
And third, move beyond mere saving to strategically invest and truly grow your wealth, leveraging the power of compounding and that long-term vision.
Step 3, invest for the long haul.
Right.
And if we connect this to the bigger picture, following these steps consistently, diligently, and with that patience we talked about over time, that is what the blueprint emphatically suggests can help you never worry about running out of money again.
Wow. That's the goal, isn't it?
It really is. It's not just about accumulating numbers in an account. It's about building a robust foundation for enduring financial peace of mind.
Peace of mind. That sounds good.
It's a holistic approach that empowers you to take control of your financial future rather than feeling controlled by it. It's about cultivating financial security, freedom, and that peace that comes with knowing you're on a defined path towards your goals.
So you've tracked, you've systematized, you've maybe started to invest or you're thinking about it. The blueprint makes the steps sound clear, but that many years of hard work and patience part,
That's the tricky part.
that's where the real deep dive into yourself begins, isn't it? It's about consistency, overcoming inertia, trusting the process.
Absolutely. The behavioral side is huge.
So maybe the question for you listening is, what small, concrete action can you commit to starting this week? Perhaps pulling up last month's bank statements for your first financial autopsy.
Just start somewhere small.
Or maybe setting up just one automatic transfer to that new savings account. Remember, true wealth isn't just about the numbers. It's really about the powerful, consistent habits we build over time.
Well said. Habits are everything.
Thank you for joining us on this deep dive into the blueprint for personal finance and wealth growth. We hope this has given you a clearer, more actionable path forward.
Hope it was helpful.
Until next time, keep learning, keep growing, and keep diving deep.